Remember in 2007 we said the Nigerian Stock Exchange was the best performing stock exchange in the world, fueled of course by margin lending, by bank proprietary positions.
2009 saw radical reforms in Nigeria's banking sector. The industry was put through the ringer when new CBN Governor Lamido Sanusi halted operation in 9 banks on the brink of collapse, injecting more than 620 billion naira into these banks. So what next after the CBN's intervention? This was the question on everyone's mind at a business day conference held in Lagos, where more than 100 stakeholders came to get answers from the governor and the federal government.
I think what has happened today essentially is an opportunity to pause and take a look backwards to see what we have done so far. Sanusi, since he came, has been quick-paced in the actions that he's taken, and I think the market is saying, okay, fine, let's do a review.
And indeed, Governor Lamido Sanusi did give them answers, but first, he defended the drastic actions he took, affirming that even the Central Bank of Nigeria was responsible for the industry's woes.
First, economic and macroprudential management. You have an economy that was not insulated from massive liquidity variations as a result of oil prices. This is an economy that depends totally on oil. Government revenues dependent on oil, government budget dependent on oil, the stock market dependent on oil. And there were no policies for macroprudential management. During this process, CBN's management did not sufficiently address the impact of these oil-related indices, and fiscal policy was procyclical, exacerbating the crisis. The second problem, which we've all heard about, was the issue of corporate governance of banks. We had banks that were controlled by CEOs. We have banks whose owners we do not know. We had banks who did not have good risk management processes, and we've now seen that some banking institutions were simply set up to facilitate fraud and theft. Then we had the issue of a lack of investor and consumer sophistication. People coming into the capital market without understanding what risks they were taking. The lack of disclosure and transparency. We had issues with a lack of regulatory framework and prudential regulations. For example, we didn't have any guidelines around margin trading, what stocks are marginable, what banks can do margin trading, what percentage of banks' portfolios can be exposed to the capital market. We didn't have any kind of, the central bank didn't issue any kind of regulations that took account of the market risks that the banks were taking after consolidation.
The CBN leader also stressed that this cleanup was not yet over, presenting his reform program, which included plans to vary the capital requirements for different categories of banks and use a hybrid monetary policy with the aim of targeting single-digit inflation and avoiding the asset bubble that led to last year's crisis. He emphasized that rapid growth in the country's financial markets was not the way to go.
The reform program is based on 4 pillars. First is to enhance the quality of banks. The second, to establish financial stability. Third, to enable healthy financial sector evolution. And 4, to ensure the financial sector contributes to the real economy.
But evidently, for this plan to work, collaboration between the CBN and the Ministry of Finance is vital, something that was lacking before. The conference saw the Minister of State for Finance and the Governor going head-to-head, with Governor Sanusi remarking that the Ministry of Finance needed to support them more in order for the reform plan to work. He voiced his plans to work with the ministry on developing the use of market instruments to hedge against oil price volatility. The minister responded by reiterating his commitment to strengthening the financial sector, ensuring to give the CBN support when needed. However, he asserted that his #1 priority was sustaining economic balance in the country.
There may be differences in terms of style. We always engage ourselves in when we lock the rooms and also when we invite the CBN governor to the council, because we've seen instances that we try to leave things to the people that are mandated to just do it, and the process it snowballs into some other effects and other impacts. And it's better for us to actually take an helicopter view and make sure that we are all swimming in the same direction, focusing on the economy, bottom line.
Experts and leaders in banking from all over the world lined up to give their take on Nigeria's financial sector. The central bank governor of Iceland, Sven Øygard, presented his strategy for crisis management in the sector after Iceland's stock exchange fell by 95% as a result of the financial crisis. He singled out tight regulation in the sector as a first step to recovery.
It is legitimate for the state and the central bank to use the fact that it's the only provider of capital to actually steer the system.
Other experts such as Luca Del Conte from Medicapital Bank in the UK said that the first task of regulators in Nigeria should be bringing back credit flow to the real economy.
Mr. Sanusi already made a very clear point in the sense that to do that he's going to have to incentivize the banks to get recapitalized. So the point is that some promises will be made naturally when receiving the capital, but after that how does it get monitored? So I believe that the real point is starting from a point where they understand that the money is coming with a price, and that cost is not just the return that happens when they exit, but also what is the process expected in the next few months. And the second point, of course, is that the CBN can monitor this process.
But for stakeholders in Nigeria's banking sector, what the industry really needed was a new culture of corporate governance.
We don't want to admit that there's a knowledge issue. See, all this corporate governance starts and falls apart if you're dealing with people who are not very knowledgeable. And that's a reason why in most other markets, the minimum requirement in terms of what the person must know to be on the board or to be involved in all these things is enforced rigorously. I think here we're still immersed in ticking boxes, and really to be a director of a company, you probably only need some very basic education. I mean, nobody's actually grilling you or asking you hard questions about whether you understand finance, whether you understand what you're getting involved in, and so on and so forth. So I think that's an area that we also have to look at to ensure, therefore, that the quality of the people who are involved in the activity is in line with the output we expect from them.
Undoubtedly, this meeting of minds was effective, and at the end, everyone's position was clear. The list of things to do is long, but institutional reforms at all levels was all important if Nigeria's banking sector is going to get back on